Looking at the Eurozone, it's easy to throw the babies out with the bathwater and just say no to all European sovereign debt. But surely there's value to be found somewhere. Making sound investments in the new sovereign debt climate is one of the panel discussions here at Bloomberg's London conference on the sovereign debt crisis. And Erik Upin of Makena Capital Management is one of the panelists. Erik is Chief Investment Officer and oversees some $13 billion at Makena. Erik, thank you for being here.
Thank you.
Let's talk about this one question that I posed right there. You look across the Eurozone, and perhaps let's look at the entire sovereign debt universe. Where is there value to be found? Where should you be careful not to say it's just all a mess?
Sure. Well, I think it's still early in the realm of values. When we look around the world, our biggest concern is there's nothing that is outright cheap, where there are real values where huge investment gains can be made. But to answer your question directly, I think it's still too early on the debt side. The value may be in equities that have gotten beaten down hard. And in the end, owning businesses that have dividends, cash flows, defensible economic moats, global reach to be able to take advantage of emerging markets and other areas of growth may be better and ultimately safer than a set of IOUs from nations that have overspent and may not be able to pay it all back.
Well, let's pick up on that thought and try to translate it to what we see going on here in Europe, because you are a multi-asset class manager, which is to say you own debt, you own stocks, you can own commodities and any number of asset classes that you like. Would you consider trying to buy those companies here in Europe with the kinds of risks that you face in the euro currency itself, or would you be comfortable investing in those companies, provided you hedged out your euro currency risk?
At the right values, the answer is yes, but the values are not overwhelming today. And what looks interesting are either companies that are trading at deep value, that are either global, or that are focused on other asset classes like the commodity complex and other real and hard assets.
How do you feel about what's going on in China? Henry Kissinger, for example, told me a couple of days ago that the Chinese would like to keep things the way they are, and if anything, would not have revalued the yuan if they didn't feel some international pressure. But it's a great thing that they are responding to international pressure, because that says something about China. But what I'm interested in knowing from you is, based on what you see, the policy signals that the Chinese are setting, is China on a stable growth track, or are we looking at a bubble ready to burst in China? And if so, what kind of impact is that going to have on some of those commodity producers that you just talked about?
Sure. Well, we're positive on China, but underweight China, in part because China is not cheap. There are not profound values in China. That's when the best investment returns are made. China is for real. The government is extremely committed. They've accomplished more in a shorter period of time with a larger population than any other nation of its size. The issue today now is that China is very bubbly in some of the property areas, and it's a great story. And often great stories and great fundamentals lead to bubbles. So like the internet bubble in the U.S., it was a great story, and almost all the predictions from experts proved to be right, but actually making money was very hard during that time when values are high.
Here's a question I bet nobody's asked you. Are we witnessing a bubble form in German government debt?
Well, early to say, and a direct answer, no, but it certainly is something that could happen from the standpoint of where do you invest if you start to question the legitimacy of both currencies and many governments.
But are the gains, for example, that we've seen in Bund sustainable? I mean, the spreads that have opened up between, say, German debt and Greek debt, or German debt and Spanish debt, German debt and Portuguese debt are just gargantuan. Okay, we've had some successful debt sales by Spain and Portugal as of late, but the spreads are still, you could drive a truck through those things.
Yeah, I think they could be sustainable for quite some time until we understand, A, the magnitude of the debt problem, B, how much of that debt is owned by banks and how levered they are and how exposed they are. If levered 40 or 50 times, a bank can only sustain a couple % hit to its balance sheet to having very little equity and therefore limited ability to borrow.